viewers, I welcome you to the video lecture series on population studies and management. Till now, we have discussed about the investor awareness and the Indian population. In this lecture, we will discuss the instruments available to the individual investor in India. Indian investment markets offer a wide range of investment options depending upon the need of the investor. The categories of investments are discussed below. Number 1, investments in shares. In the capital markets, the investment unit is often called share. In the general sense, it is used as a unit of the corporation, but it is also used for collective instruments such as mutual funds, limited partnerships, and real estate investment trusts. Shares are often floated in the capital markets to raise share capital. The term shareholder is used for the owner of the shares. A share is the term generally used for the indivisible unit of capital that represents the ownership status between the company and the shareholder. The denominated value of the share is called its face value, and it represents the capital of the company. This value may or may not be the market value of those shares. The income that is received from the shares is called dividend. The purchasing and selling of the shares are often done through the members of the stock exchanges. The valuation of the shares is based on the value at which it is sold. As for the investor, the dividends that are received by the investors are tax-free, but the company that is paying the dividends has to pay a certain tax. A. Stocks. The term stocks is generally used for the equity stocks of the corporations. It is the residual claim of the shareholders that is met after meeting the higher claims such as the secured and the unsecured debt. Generally, stocks are of two types, and these are common stock and preference stock. The common stock generally carries voting rights and can be exercised at the time of corporate decisions. The preferred stock, in contrast, does not carry any voting rights, but receives dividend payments before the ordinary shareholders and are given preference at the time of liquidation over the common stock. Then there are convertible preferred stock, which include an option that the preferred shares can be converted into a fixed number of ordinary shares. This can be done any time after a certain predetermined date. Preferred stock can be hybrid, having qualities of a bond for fixed return and a common stock for voting rights. B. Stock options. Stock options come under the class of stock derivatives. The asset class is called derivatives for the reason that their value is dependent on the underlying stock. The main derivatives of stocks are futures and options. The underlying basis for evaluation of both may be the index of stocks such as Nifty, BankX, etc., or an underlying stock itself. Stock options is a class of options. There are broadly two types of options. They are call options and put options. The call option is a right and not an option to buy the stock at a fixed price, and the put option is a right and not an obligation to sell the stock at a future date. Thus, the value of the stock option changes in response to the value of the stock. Stock future. Stock future is an instrument which can be easily traded between parties other than the two initial parties to the contract. These parties initially agree to buy and sell an asset for a price agreed upon today, the forward price, with delivery and payment occurring at a future point, the delivery date. Because it is a function of the underlying asset, the future contract is a derivative product. Contracts are negotiated at futures exchanges which act as marketplace between buyers and sellers. The buyer of a contract is said to be long position holder and the selling party is said to be short position holder. As both parties risk their counterparty walking away, if the price goes against them, the contract may involve both parties lodging a margin of the value of the contract with a mutually trusted third party. The first futures contract were negotiated for agricultural commodities and later for natural resources such as oil. Financial futures were introduced later, and in recent decades, currency futures, interest rate futures and stock market index futures have played an increasingly large role in the overall futures market. The second are mutual funds. A mutual fund is a professionally managed investment fund that pools money from many investors to purchase securities. While there is no legal definition of the term mutual fund, It is most commonly applied to open-end investment companies, which are collective investment vehicles that are regulated and sold to the general public on a daily basis. They are sometimes referred to as investment companies or registered investment companies. Mutual funds have advantage and disadvantage over investing directly in individual securities. Now, namely, the advantages are increased diversification. A fund normally holds many securities. Diversification decreases risk. Daily liquidity. Shareholders, open-end funds and unit investment trusts may sell their holding back to the fund at the close of every trading day at the price equal to the closing net asset value of the fund's holdings. Professional investment management. Open and closed-end funds hire portfolio managers to supervise the fund's investments. Ability to participate in the investments that may be available only to large investors. For example, individual investors often find it difficult to invest directly in foreign markets. Service and convenience. Funds often provide services such as check writing. Government oversight. Mutual funds are regulated by the SEC. Ease of comparison. All mutual funds are required to report the same information to investors, which makes them easy to compare. Now, looking at some of the disadvantages of mutual funds is that they charge a fees and there is less control over timing of recognition of gains. Also, there is less predictable income and there is no opportunity to customize. Basically, there are three types of mutual funds: open-end funds, unit investment trusts and closed-end funds. The most common type, open-end funds, must be willing to buy back shares from investors every business day. Then we look at what are exchange-traded funds or the ETFs. They are open-end funds or unit investment trusts that trade on an exchange. The non-exchange traded open-end funds are most common, but ETFs have been gaining in popularity. Mutual funds are generally classified by their principal investments. The four main categories of funds, apart from the above mentioned, are money market funds, bond or fixed income funds, stock or equity funds, and hybrid funds. Funds may also be categorized as index or passively managed or actively managed. Money market funds. Money market funds invest in money market instruments, which are fixed income securities with a very short time to maturity and high credit quality. Investors often use money market funds as a substitute for bank savings accounts. Though money market funds are not insured by the government, unlike bank savings accounts. What are bond funds? Let's see. Bond funds invest in fixed income or debt securities. Bond funds can be subclassified according to the specific types of bonds owned, such as high yield or junk bonds, investment grade corporate bonds, government bonds, and by the maturity of the bonds held, that is short, intermediate or long term. Bond funds may invest in primarily Indian securities, domestic or foreign funds also, in both domestic and foreign securities, global or world funds, or primarily foreign securities, international funds. Now, let's see what are stock funds. Stock or equity fund invest in common stocks which represent an ownership share or equity in corporations. Stock funds may invest in primarily domestic securities, domestic or domestic funds, in both domestic and foreign securities, global or world funds, or primarily foreign securities which are called international funds. They may focus on a specific industry or sector too. A stock fund may be subclassified according to two dimensions, the first one being market capitalization and the second is investment style, that is growth versus blend, core versus value. The two dimensions are often displayed in a grid known as style box. Market capitalization indicates the size of the companies in which a fund invests based on the value of the company's stock. Each company's market capitalization equals the number of shares outstanding times the market price of the stock. Market capitalizations are typically divided into the following categories: small cap, mid cap and large cap. Funds can also be classified in these categories based on the market caps of the stocks that it holds. Stock funds are also subclassified according to their investment style, growth, value or blend. Growth funds seek to invest in stocks of fast-growing companies. Value funds seek to invest in stocks that appear cheaply priced. When selecting a mutual fund, an investor has to make an almost endless number of choices. Amongst the more confusing decisions to be made is the choice between a fund with a growth option and a fund with a dividend reinvestment option. Each type of fund has its advantages and disadvantages, and deciding which is better fit will depend on your individual needs and circumstances as an investor. The growth option on a mutual fund means that an investor in the fund will not receive any dividends that may be paid out by the stocks in the mutual fund. Some shares pay regular dividends, but by selecting a growth option, the mutual fund holder is allowing the fund company to reinvest the money it would otherwise pay out to the investor in the form of a dividend. This money increases the net asset value or the NAV of the mutual fund. The growth option is not a good one for an investor who wishes to receive regular cash payouts from his or her investments, therefore. However, it's a way for the investor to maximize the fund's NAV and upon sale of the mutual funds realize a higher capital gain on the same number of shares he or she originally purchased, because all the dividends that would have been paid out have been used by the fund company to invest in more stocks and grow clients' money. In this case, the fund holder does not receive more shares, but his or her shares of the fund increase in value. The dividend reinvestment option is quite different. Dividends that would otherwise be paid out to investors in the fund are used to purchase more shares in the fund. Again, cash is not paid out to the investor when dividends are paid on the stocks that comprise the fund. Instead, cash is automatically used by the fund's administrators to buy more fund units on behalf of the investors and transfer them to individual investors' accounts. Fund holders realize a capital gain upon the sale of their units in the fund, which in the case of dividend reinvestment option will probably be more funds units than they started with. No single mutual fund is perfect for every investor. That's why there's so many out there with so many different options. When investing in a mutual fund, it's best to examine all of the particulars of the fund to avoid investing in a fund that doesn't suit your individual requirements for growth or cash payout. Now we're going to discuss investment in commodities market, including gold. Commodity trading in India has a long history. In fact, commodity trading in India started much before it started in many other countries. However, years of foreign rule, droughts and periods of scarcity and government policies caused the commodity trading in India to diminish. Commodity trading was, however, restarted in India recently. Today, apart from numerous regional exchanges, India has 6 national commodity exchanges, namely Multi-Commodity Exchange, that is the MCX, the National Commodity and Derivatives Exchange, that is NCDEX, the National Multi-Commodity Exchange, that is NMCE, and the Indian Commodity Exchange, that is ICEX, and ACE Derivatives Exchange, and the Universal Commodity Exchange, that is UCX. The regulatory body is Forward Markets Commission, that is FMC, which was set up in 1953. As of September 2015, FMC is merged with the Securities and Exchange Board of India, that is SEBI. Investment in the real estate in the form of REITs. What is a REIT? A REIT is a real estate investment fund. It is a company that owns and in most cases operates income-producing real estate. REITs own many types of commercial real estate, ranging from office and apartment buildings to warehouses, hospitals, shopping centers, hotels, and even timberlands. Some REITs also engage in financing real estate. REITs were designed to provide a real estate investment structure similar to the structure mutual funds provides for investment in stocks. As of August 2014, India approved creation of real estate investment trusts in the country. Indian REITs, country-specific generic version I-REITs, will help individual investors enjoy the benefits of owning an interest in the securitized real estate market. The greatest benefit will be that of fast and easy liquidation of investments in real estate market, unlike the traditional way of disposing of real estate. The Government and Securities and Exchange Board of India, through various notifications, is in the process of making it easier to invest in real estate in India directly and indirectly through foreign direct investment through listed real estate companies and mutual funds. In the budget of 2014, Finance Minister Arun Jaitley has introduced a law of setting up of rights. A real estate investment trust is a trust which holds real estate assets, that is buildings, office premises, land banks, etc. The units or securities of rights are required to be listed on a recognized stock exchange, and it provides retail investors an opportunity to indirectly hold stake in real estate assets. The concept of right business trust now exists in several countries worldwide like Australia, Singapore, Japan, France, UK, etc. In Indian context, the Securities Exchange Board of India introduced the right regulation in September 2014, issued the final right regulations wherein a right duly registered with SEBI can be set up as a trust under the Indian Trust Act of 1882. The structure of right gives a clear picture of the chain of transactions such as A. Collection of investment from various investors, B. Investment in real estate properties to earn income, and C. Repatriation of the income of the right to the investors. A fixed deposit. Now, it is a financial instrument provided by banks which provides investors with a higher rate of interest than the regular savings account until the given maturity date. They are considered to be very safe investments. Term deposits in India is used to denote a large class of investments with varying levels of liquidity. The defining criteria for a fixed deposit is that the money cannot be withdrawn from the FD as compared to a recurring deposit or a demand deposit before maturity. Some banks may offer additional services of FD holders such as loans against FD certificates at competitive interest rates. It is important to note that banks may offer lesser interest rates under uncertain economic conditions. The interest rate varies between 4 to 11%. The tenure of FD can vary from 7, 15, 45 days to 1.5 years and can be as high as 10 years. They also offer income tax and wealth tax benefits. Now we look upon the education regarding financial awareness. It should ideally be directed in two ways. One, knowledge, and the other to remove psychological barriers to risk, decision-making skills, resilience, attitude change, behavior modification, all form a field of management. Behavioral finance role in tackling mental blockages. Holistic appeal to enlighten the investor and to ensure his participation in investments and to propel India to an altogether stronger trajectory of growth, and this time a self-reliant growth. Behavioral finance combines the social and psychological theory with financial theory as a means of understanding how price movements in the security markets occur independent of any corporate actions. To give an example, suppose a lawsuit is brought against a tobacco company. Investors know that when this has happened before, the share price of the tobacco company has fallen. With this in mind, many investors sell off their holdings in the company. This selling results in further decline in the security value. Decision making is a complex activity. Decisions can never be made in a vacuum by relying on personal resources and complex models which do not take into consideration the situation. Analysis of the variables of the problem in which it occurs is mediated by the cognitive psychology of the manager. A situation based on decision-making activity encompasses not only the specific problem faced by the individual, but also extends to many other fields of activity. Now friends, concluding the entire lecture series, we state that the investment aptitude in India needs to be increased so that the people of the country can reap the benefits of success of economic growth. In India, mostly we find institutional investors and individual investor participation is quite low. The reasons behind this is the risk-averse nature of the people, excessive belief in the investment in gold, lack of knowledge about investment tools available, and lack of knowledge about the capital markets and the working. We have also tried to explain the capital markets in further detail including the classification and the basis of this classification, the various investment instruments such as shares, mutual funds, real estate investment trusts, investment in commodities such as gold, derivatives such as options and futures, bonds, etc. The benefits of investing are discussed in detail. The role of Securities and Exchange Board of India has been discussed in detail, especially the role that it plays in education of the investor in India. Later, the various approaches for the enhancement of investor aptitude are discussed, suggesting both knowledge sources and to understand investor psychology and counsel the investor to remove psychological barriers that exist between investor and investment. All this has been attempted with a hope to bring about the benefits of investment at the doorstep of the people who belong to the fastest economy of the world, that is India. Thanks for watching this program.